Hello, this is Mike Swanson. I run the website WallStreetWindow.com. The odds are that you're watching this video because you got an email from me like this one. I send out an email every single morning before the opening bell with links to my market commentary and the top articles and stories of the day that you need to know about. And today I want to talk with you about a long analysis of the financial markets that the famed investor Jeremy Grantham has written. It got a lot. Some of it got leaked out last week, and a lot of headlines are made about it because the headlines are saying things like Grantham is predicting a 50% decline in stocks, and so forth. But if you actually read what he's saying, there's a lot more to it than that. There's a lot of nuance. And I think it's really important to understand what he's actually arguing. Look, I'm somebody that turned bullish on the stock market this year, a couple weeks ago, and I was bearish last year all the way down. I turned bearish in 2021, but I am now bullish, and the market has been rallying. I believe this is the start of a cyclical bull market. And if you're new to me, you can see on YouTube, I've been doing videos saying that. However, that said, it is very important as an investor, a trader in these markets, to read other people's opinions, especially if they do not agree with yours, and get a broad-based understanding of what's going on. And frankly, there's a lot to what he's writing that I do agree with, even if I'm bullish on the market this year. But it's important to understand the problem with the way the internet has evolved. What you see on it when you load up social media, Facebook, YouTube, Twitter now, all these websites, the algorithms show you the content that they believe you uniquely are interested in and will click to keep you on the internet. The problem with that is it can create a bubble where you are fed information that just confirms what you want to hear or what you already believe, and you can get stuck in a bubble. The crypto world is the greatest example of this. All the crypto gurus that you've seen on YouTube and elsewhere were making wild predictions that had no basis in reality. They're telling you that Bitcoin and these cryptos would go up as a safe haven when the stock market fell. Well, they crashed last year. It was all lies, but it was lies delivered by the algorithm. So in this people have been, I fear, over years of usage of the internet, have been trained by these algorithms to like tune out anything that doesn't tell them what they want to hear. So I just want to implore you to read the Jeremy Grantham article, and I'm linking to it in in this video. Once I can get to it. This isn't exactly it. State of the bubble. Things get more complicated. Now, I list this guy. He's a very serious investor, and he's been in the markets longer than I have. He's in his 80s, and he came out at around the same time I was doing it in 2021, saying, "Look, this is a bubble, ARK." Crypto, meme stocks, classic bubble signs, similar to what was seen in 1999. I saw it. I was trading back then. And then it busted in 1999. And there was a 3-year bear market in internet stocks. Many of them went to zero. Most of them fell 90%. If they still, didn't go to zero, they still fell 90%. And the NASDAQ didn't recover for over 10 years. By valuation metrics and the behavior of people, it was a massive overvaluation and speculative mania. And 2020 brought a similar moment with the meme stocks, with the crypto, with the rise of the Robinhood trader. And he was pointing this out and warning that, look, this is going to go into a bust. And we saw the bust happen last year, obviously. However, while he is claiming that it's going to continue, and that's what's getting all these headlines last week. He's also saying that near term, he isn't so sure, that he acknowledges that we are in a stock market rally, and he lists factors for why this rally could continue. That's not showing up in the headlines, but that's what he's saying in his article. He's saying inflation is subsiding, the labor market's strong, the Chinese economy's reopening, and there's a powerful 4-year presidential cycle now on tap. And that cycle shows that from October of year 2 to April 30th of year 3, before the year before the presidential election, which will mean this October till April 30th of next year, the market has an annualized return over 25%. All other times, not so good. And that's because the presidential party, the president, the executive, he tries to do things to stimulate the economy, to pressure the Fed into not raising rates or perhaps lowering rates if you can do it, and to goose the financial markets. Then after the presidential year, often the market will have a bear market. That's what happened in 2001. That's what happened delayed, you could say, in 2022. But the internals of the market peaked out in 2021 after the 2020 election. So, but all that said, he also, in this article, lists all the negative factors that could drag down the stock market too. High valuations really being one of them. Long-term issues of raw material shortages, continue most likely geopolitical resource shocks around the world, all sorts of issues over the aging of the populations of some important countries, United States and China. It's already happened in Japan, obviously, Europe. So anyway, one could read this, and if you do, it's in the link I got. And also my email list, if you want to get on it for free to get all my updates, it's in the link too in the description of this video. But all the factors, the macro factors, are all contained in this article that are really important to know about. But the general reader may read this and they saw the headline 50% decline, and they read this and they don't come away with a specific exact prediction of when the market's going to drop or what's going to happen over the next 3 months or 6 months or even this year. Lots of warnings, but nuanced with some of the reasons why the market could go higher. So what should we take away from this? First of all, you need to know these factors. You need to know what is going on with the economy. What are the fundamentals? But I make actual tactical decisions based on technical price action. And what I saw when he was making these warnings in 2021 was that the internals of the stock market had peaked and were in decline as the S&P 500 and the NASDAQ continued higher in 2021. And that consistently, in the history of the stock market, at least as long as these sort of things have been tracked, led to either bear markets or 20% or more corrections. And that's what we got, the bear market. But this fall, the internals turned up. And to me, that's a sign that we're not simply in a bear market rally like the many we saw last year, but the start of a cyclical bull market. Now, I have no way to predict how long that bull market will continue, but my view actually does not conflict with the overall tone and warning of this article, because I think this is a cyclical bull market within a secular bear market. Cyclical bull markets last from 2 to 5 years. 5 really is the max. And if this lines up the presidential cycle, we're looking at probably 2 years. We're looking at a Federal Reserve that is poised to raise rates one more time, take their foot off, or 2 more times one more time after this week, but take their foot off the pedal and try to do nothing. And if they do make a move, it could be lowering rates. I don't think they'll lower rates this year, but they could easily be doing it next year. And that would line up with the Fed, being a little easy for Biden in the presidential election. And after the election's over, if the inflation doesn't go away or comes back, then it's time to raise the rates again. And that would create another bear market. But we're in a cyclical bull. I think it's likely to last 2 years. I can't really predict what happens further out than that. It's very difficult to do. But I want you to understand, a secular bear market is not a 2 to 5 year cycle. It's a 10-year or longer cycle in which the cyclical shorter term cycles play out. So when it comes to the Dow Jones Industrial Average, it had a secular bear market from 1968 to 1982. The Dow went sideways. This is a chart of that period. But within that overall sideways trend, the Dow didn't break out after 1982. There are multiple cyclical bears and cyclical bulls. As you can see, the biggest bear was in 1975. 73 was a big bear. 69, I think it was 77, 78, 81, 82. But the market was like going this up and down, but not breaking out, not going up year after year to new highs. And that's the type of environment I think we're in now. We're not going back to the way things were before 2021. And you can read Grantham's article to find out why. It's all laid out there. And we're not going back to the way things were. We're just not. And one reason why is these cycles, it's not just what happened in the 70s. They happened from 2000 to 2009. And that's the comparison Grantham has been making 2 years ago and now to the situation today. When he talks about valuations and bubbles and manias, he's comparing today to what happened from 2000 to 2009. And this is a inflation adjusted chart, the S&P 500. And when it was inflation adjusted, it was a complete total disaster. From 2000 to 2009, gold went up. Gold outperformed the stock market while the stock market had a dismal time, fell 60% in value from 2000 to 2009 when adjusted for inflation. So that's kind of what he thinks is going on. And I agree with that. But, we're in a cyclical bull market, for 10 years, inflation. And, I don't think, so the bull market could take us, the S&P up to the high of the last high of January 2021, and it could peak out there, or it could go up 5% more and then come all the way back down to where we are now, or where we were in October. And that could play out over several years. So that's kind of the environment I think we're in, although I think we're in a positive year. But look at 68 to 82. When adjusted for inflation, the market did not go sideways, but it fell 63% in value. If you follow things such as the cyclically adjusted PE ratio, that's how that got to a low valuation in 1982. The same thing happened in 1949 and 1932 with the cyclically adjusted PE ratio. And you can see how that secular bear market caused stocks to fall in value for well over for 20 years, basically. And something similar happened with the bear market around 1906 and 1921. This is all adjusted for inflation. The point is that secular bull markets last a long time. They're an underlying trend. The cyclical phase, which is what I've been talking about when I'm saying I'm bullish, is bullish now, but it's a 2 to 5 year deal. And then when it ends, you go back down. We're in your secular bear market. When you're in a secular bull market, you just go up, up, and up. But that's not, that game's over. Why? Because what also influences these long-term phases, it's not simply stock valuations, it's also the long-term changes in inflation and in monetary policy. And we have seen a mega shift since 2020 in interest rates. And that's why we're not going back to the way things were, because what happened in 2020, the Fed took rates to zero and it did a massive QE bond buying operation. Now, those weren't new, unprecedented moves because the Fed had lower rates down to zero in 2009 and did QE operations in 2008 for the very first time. And it would you'd get, periodic slowdowns in the economy or declines in the stock market, and they would re-engage in those money printing policies. And that's how they were behaving in the last secular bull market from 2009 to 2021. But things have now changed. From 1968 to 1982, what was going on? Inflation exploded in 1967, much like we saw 2 years ago. And it took almost almost 14 years for the inflationary trend to be broken by the central banks. And that's how the secular bear market was going on. 1929, 1949, the Great Depression and World War II. So, and there are big changes in policies then. So what happened when they took the rates to zero? Remember, there were negative yielding bonds in different parts of the world. That was the lowest level of interest rates in all of human history. That wasn't going to continue forever. It represented an extreme moment that was going to come and go, and it went, and it means that as it went away, we entered a new era, a new secular phase in the markets. That means a secular bear market, but we're now in a secular bull market. So I don't really disagree with the overall tone of Jeremy Grantham's article. I don't think the market's falling 50%. And I'm not going to talk that way and create, those type of headlines don't bring understanding and clarity. They bring clicks for people who are bearish. People who are bullish are just going to ignore them or get angry. But that's not what you want to do. You want to understand what people are saying that make well-reasoned arguments so you can know what's going on. And, you shouldn't be overly bearish on the market now, but you shouldn't believe that this market is going to trade like it did in 2020 either. In fact, already the sectors and the stocks that have been leading this market over the past couple of months are completely different from what they were in 2020 because we're in a different macro environment. That's why it has been mining stocks, copper stocks, consumer staple stocks, REITs, and so forth that have been leading this rally, emerging markets, and not your ARK ETF, not your crypto coin, which has remained completely useless in this macro environment because it never did what they told you it would do, never could replace the dollar, never could become money. It's useless. It's an instrument of speculation, like a call option on the NASDAQ. That's all it is. If the NASDAQ continues to go up, and I think it will, at some point, crypto will get a bid. But as soon as the NASDAQ rally comes to an end, crypto will go into another tailspin because it's useless. It's all it is a call option on the NASDAQ. So read the article, subscribe to my email list, If you like these type of videos from me, hit the like button. If this is the first time you see me on YouTube, hit the subscribe button, hit the bell next to it, and YouTube will send you an alert as soon as my next video is up. And I'll be talking with you later.